Good afternoon, everyone. Hear me okay? So, just to let you know, official open house tomorrow in the Central Room. Pretty excited about that for everyone. Just so you could see how all of us traders trade in the Central Room, and you can sort of uh, figure out what personality jives with you the best. So, just keep that in mind. So, what are we going about today? Today is all about showing you about implied volatility. So the theory in here is that with the new administration, a lot of takeover desks are anticipating a big surge in takeovers. Now, keep in mind, over my 44 years of doing this, I found that the more lax the regulation, the more you see unusual option activity. So just keep that in mind in there. So that means looking for unusual option activity because you only get a slap on the wrist if you do insider trading. And keep in mind, I've just seen this cycle over my 44 years. It's happened with all shapes and sizes of administrations, but it works. So let's go into it and I'll show you what we're talking about. So, number one, what's the theory with this? The theory is that you see a rise in implied volatility. That's this down here. So you can actually just go to studies and you go into implied volatility. Just add it on the bottom. That's all I did. Went to a normal thing, implied volatility. I've tried the increased volatility. I haven't seen it work. So implied volatility, that's it. You go to studies and it's in there. The thing is, there's a number of reasons that implied volatility might go up. So just keep that in mind. So what are they? Number one, if there are earnings coming out, most of the time volatility goes up into earnings because of the uncertainty. Number two is an event like a shareholders meeting or something. Number three is an event like on a biotech if they're about to have a study come out. I'll show you a good one. IMMR. Right. See this $9 stock? Look what the sorry, wrong one. Let me find it for you. Pretty impressive. It's a $10. Let me find it. Well, it's like a $14 stock, but the expected move for next month is 16. It's actually higher than the price of the stock, and that's because they have a big old trial coming out. Pretty wild, that kind of stuff. So that's one of the reasons. So not that stock, but so you have event stuff coming out. You have earnings coming out. Obviously, that's an event. You have that if a stock goes way down or way up, well, guess what? That just means the realized volatility is going up. So that's another reason. What we're looking for is an accumulation of calls when nothing's going on with the stock. I can't tell you how many people have gotten it wrong that when the stock's up like this, they're like, oh, there are a lot of calls trading. There should be a lot of calls trading because the stock's way up. You're looking for it before it goes up. So I'll show you on how I do it. So number one, you'll see in Hershey's right here, see the uptick in the implied volatility. So if you see unusual call activity and that going up, that usually means they're buyers because it's forcing up the volatility. And I'll show you what I'm talking about in here. But the key was not that it was increasing, but it was forming a bull flag. So that's when you start doing like spreads. Sometimes you can anticipate a lot of takeover stocks. In my history of watching them, they form bull flags first. So you could try to anticipate and you see it here. That's not a bull flag over here. That is. And then you can look to do like vertical call spreads, call debit spreads. So now let me show you with Hershey's what we're talking about. As you see right down here, November 27th on the bottom here, that's when that started popping. So I just go and I'll show you an example. We'll go to Analyze tab and we'll go back here. We're going to go to November, let's say 25th. Now, you don't want to go just into November. You don't have enough time. So I went into January 17th, right in here, January 17th, in here, in Hershey's, not XSP. There, January 17th. And you're going to see the open interest in here, right here. You see the 1,000 here, and you see 1,600 and 1,300 and all that. But I want you to watch the volume over here. So watch what happens when you start moving the date using the Analyze tab with Thinkorswim. You move the date there. You seen anything yet? No. Remember, I said it starts about the 27th or 28th. Still nothing. There, you're starting to see it. See that? Starting to see some volume coming in. At midnight is when open interest updates. So you see the 220 and the 205. See the open interest. Now go to the next day. And you see how it went up. Now it's 700 and 900, and look at that volume come in. So if the open interest goes up and the implied volatility goes up, then you know those are buyers. See the 1,400 there? Now watch what happens the next day. Remember, this updates at midnight. There, 1,600. Look at all these on how much open interest is accumulating. See all that? And it just keeps going every day. 3,000 now. So does that go? And that's on it when it went down. In fact, very interesting. Just take this and go to the day before. So go to the 4th. You see how the stock's 179. See on how it's bid 610, offer 670. Well, the next day, if the stock's down 2 points, they should be down a lot. Guess what? They're almost the same price. That is buying pressure. That's buying pressure. So you go into here and you see it's 3,800 now. You go into here and now keep in mind the stock's gotten rocked. Don't get me wrong. That's why you have to look for the bull flag. And guess what happened? Yeah, it went up 18. So I'm just telling you that when you go back to here and you see the accumulation of calls and it's forming a bull flag, you can anticipate and go do an out-of-the-money vertical debit spread. So we can actually go back to this and go to 12.6. I'll show you. Go into 12.6. Right here. We can take that off on the left because that takes up a lot of bandwidth. See how it's pre-buffering? And I'll show you in this. Like I said, this right now is about implied volatility and combining charts, not about volatility. So just keep that in mind. It's not about VIX calls. It's about trying to anticipate takeovers. So you see Hershey's up 20. That's on a Friday. Keep in mind, about 80 to 90% of takeovers are over a weekend. Now go to the chart on this. Yeah, you see it developing that. So that's when you anticipate on a Friday because you've seen the implied volatility going up. So watch what happens on Monday. Still pre-buffering. I think it was on Monday. I'm hoping it's on Monday so it goes with the theory I'm showing you. They're up 18. Like I said, it happens usually over a weekend. So on something like that, when you're anticipating, looking at that bull flag, remember that bull flag? And you're seeing the volatility go up. It's even going up when the stock's going down and not plummeting, just going down. So you could go into December 6th and you can go and do a vertical debit spread. I do not like just blindly buying premium because you don't know what happens over the weekend. So you go into here and you probably go and buy a 190, 200 call, something like that. You can even do a 180, like a 180, 190. So let me show you. So you go and buy this vertical call debit spread. It was like 248. 248. It's not that far out of the money. But when you go into December 9th, all of a sudden that thing is going to be huge. The 80-90. Look at this. 80-90 now. Well, it's not really 7 because they widened the spreads on it, but it's high. I mean, you can see the bid and ask. It's 20. 20. So actually it is, it's 13 points in the money. So you triple your money. The key in there is you're combining the chart with the pop and implied volatility. So just keep that in mind in here. So I usually like to lay off the risk with something just 10 points wide because you don't know if it's going to get taken over. So just keep in mind that a lot of what I do is like a bookie laying off risk. So if I go and do this one, you can't go wider because they're not worth anything. It's not good enough to lay off the risk. So you got to have where you can lay off the risk. So, I mean, that's the way I look at it, and it worked. So now when you go back, how do you find more of them? Well, the way I find them is doing this. I go into call sizzle index, which is the amount of calls relative to normal. Relative to normal. And I look at the implied volatility, which the implied volatility percentile. That's just another drop down on Thinkorswim. Just keep that in mind, another drop down. So what is that? Basically, it's telling, well, if you ever wonder, and if I don't say it right, I just want to show you. Just go to implied volatility rank on Google. And what the implied volatility is compared to its historical over the last 52 weeks. Now, I wish it had over the last, you could modify that. But just keep that in mind that you're looking at like a Hershey's and the implied volatility rank went way up. So the first thing I do is I go to like the Russell 3000. I took almost all stocks and I went to the implied volatility percentile, but then you want to see if any of them have unusual calls today. So that's what I'm doing. So and the other is I would put on your watch list, I would put in the put call ratio. So if you see the call sizzle high, but they're more puts than calls, well, that throws everything out. So when you go into this, I'm looking at the implied volatility of, let's say, and also remember, you don't want something that's way up because you're going to have a lot of calls. So I'll show you one I just found. So we'll just go to it so you get an example. Here's a $38 stock. Now, keep in mind that I don't like buying things on the way down. I think you know that if you listen to me enough. So don't get me wrong. Demand zones do matter. It's this that I like a demand zone combined with a reversal. So if something is at its moving average, I'm going to then look for a reversal pattern. So if you go into here, you'll see it. So you'll see the little reversal pattern. So it sold off to support. And then, well, number one, it had a bull flag there, but a bull flag there. But I want to show you and go back to the implied volatility. And as you see, for some reason, with the stock slowly going up after earnings, usually the volatility goes straight down after earnings. So when you see it slowly going up like this, and you see a possible bull flag, yeah, you can try to anticipate. So just keep that in mind. That's one way I do it. And this kind of stuff seems to work in the long run, especially if you see a real tight bull flag on a daily and you see the implied volatility going up. I'll be a lot more aggressive. If it measures, let's say 8 points, then I'm going to do probably something that bets on it going up at least 8 points. So this is a consolidation. So it's a measured move theoretically. So, and I'll tell you, I'll brag about one I did on the floor when I was on the floor and you had all the takeovers, Northwest Air. So if any of you were on the CBOE when I was there, so I used to get these daily graphs. They were blue and they'd come every weekend. And Northwest Air had unusual call activity. And the chart had a beautiful bull flag. So I went in there on a Monday, even though it was a Monday, and went and bought 100 lot of calls, $1.80. Next day it opened up 16 points. Yeah, that's 16 times 100 lot. So you can figure that out on your own. But they all thought I had inside information. They're like, how the hell do you know it'd be taken over? I said, implied volatility going up in a beautiful bull flag. And I showed them the flag in daily graphs. And they're like, okay, you didn't know anything. So I'm telling you, if I could do it then, you could do it now. So just keep that in mind. If you could do it then, you could do it now. So, and like I said, that's on demand on the upper right. There, upper right. So just keep that in mind on how we do this stuff. So that Northwest Air worked. So you can do a couple of things in here. So in here. So I'll show you. So the first thing in here, you definitely want, let's say, call sizzle. Call sizzle. I totally understand that. But usually with this, what I'll do is I'll go in and I'll look at all the implied volatility percentile, take out on demand, and I'll actually look at every one. You got to be picky. So what I mean by that is when you do, let's say, implied volatility percentile, you're also looking at the call sizzle. Because if I'm going to initiate something today, I want to see unusual call activity. So I go back up to this, all of these, and I'll just start pressing the, chart button. So that's one way to do it. The other way to do it is definitely this way. You could do a scan. And you could do a scan and just do this. Load scan, personal, unusual call activity using IV percent. So I just took the call sizzle to last is at least $2. Now that's a little, usually the takeovers we're talking about are over 30. Let's just take 20. Open interest 2,000. I want where it has some active open interest. I want it in an uptrend. Most takeovers happen in an uptrend. You don't have to have that in there. So you might say, but don't you want a stock that's down in the dumps and has like a high price to book or something? I found that most takeovers are when a stock is growing. So it's usually over the 50 because it's already acting pretty well. Let's go back to Hershey's. Was Hershey's over the 50? It's a good question. So we're going to go into here. We're just going to take the 50. So it was at the 50. So that's a little rough. So what I do is take off that. You don't need that, and you go average volume, open interest, and I want the implied volatility percentile that high. Now, the call sizzle, you might not need because maybe today it doesn't have any calls, but you could do it this way. So let's save this scan. We're going to save that like that. So we're going to go back in. Well, it worked perfect. And then in the essentials room, I can share this. So let me share it. Like I said, I can't do this in the YouTube. This is why you need the essentials. Yeah, there's an interesting scan for you. So now, don't get me wrong. A lot of times I'll go in here and I'll just take call sizzle and go through every single stock. Now, another way to do this is you can add a squeeze. So go backwards. See if there's a contraction in volatility. So how would you do that? Well, I reverse engineer it. So you can add if there's a bull flag. So let's take Hershey's again. Did Hershey's ever have a bull flag? Yeah, it sure did. Look at that. A 4-hour bull flag. Isn't that interesting? So let's add it. Let's add it. Let's see if anything pops out. Now, don't get me wrong. You might ask, well, why are you doing this? Because I'm going to be sharing this with my room later. So let's go and put in study. And let's go and put in license study, TTM squeeze scan. And what we're going to do in here is put a 4-hour. 4-hour. That's it. And let's see if anything pops up. Maybe nothing. Yeah, nothing popped up. So I'll take off call sizzle. Let's see if anything pops up. So I think this is really interesting to do this. Clearwater Analytics. I've never heard of it. CWAN. Let's see what happens. CWAN. Yeah, not bad. Not great. Not a tight one. But that's the kind of thing I'll do. And I'll go back and look at options. So I wish it, well, it does. Look at that, 4,000. So let's go to CWAN and let's look at what I was showing you. Let's go and put implied volatility. Remember, on the bottom, that's all I'm doing. This is all stuff you could do. It's there. So now what I'm going to do is make this a little easier for you to read. There, and let's put in, yeah, that's slowly gone up. Why has it gone up? I don't know. Now I like to look at news and stuff, but there's a nice example. Maybe it's forming a big old bull flag. So just keep that in mind there. Maybe that's a bull flag. It's not tight. So if I did something, it can't be December. I'd have to go out to January. I wish it had more open interest. Now, can you just go and buy a 30? Sure, you could. The problem is if it doesn't move and stays in that bull flag, you're going to lose everything in there. You'll just lose on time premium. Then you'll be in the hope stage. Now, if it had a tighter bull flag, real tight, yeah, I'd probably go and buy these. Because it doesn't have 27 and a half, that's extremely expensive to buy a 5 wide. So I'm not doing that. But I just wanted to show you that kind of thing. So that's one way I tried to do it. So just keep that in mind. That's one way I try to do it. So all I'm doing in here is I can do it with a scan, or I can do it like this and just go and look at the implied volatility percentile right here. So if you want, you could make it a watch list. So you could go and take this. What I did is I took active Russell stocks. So I just went Russell active. There. And then what you can do is add implied volatility rank. And let's just see what it looks like. Let's just see what it looks like. So there they are right here. And let's see if any of them look compelling when you use that chart that shows the implied volatility. I mean, I'm doing this in the background all the time. I'm not on YouTube and stuff. So let's just show you. So let's just take these in here. So let's see. Yeah, there's one. I have no idea if that's Frontline that does fleas and stuff. That's pretty impressive. And what I do is when I see that, I then add it to my takeover rumor list. There. ARI, there's another one. What the heck is that? That's pretty impressive as well. CNX. Yeah, look at that go up. Now, on the other hand, the stock got hit. So a lot of times volatility goes up if the realized volatility is going up. But you can add all of these. Add them all to your list. EVH. Yeah, down in the dumps though, but that's pretty impressive. But you're going to get an increase if a stock crashes. I mean, these are pretty cool. There's one. So let's go and put this one in. FCPT. Try to say that quickly 3 times. What's the problem? No open interest. So I have no idea why it did that. ACHR is a monster. We were in it down here. We got out too early, but we still made money. There's another one, Alchemies. All right, and I always pronounce it wrong. There you go. Now, the first thing you want to go, and I don't have a lot of time, is you got to go to open interest and see if it has a lot. That's not a lot. That doesn't make me excited. I like when you see like 8,000. And then you go on the left and you look to see, are they, they're participating in an investor conference. They might be like announcing some trial. So you got to be careful. But that's one. So all I'm doing in here is I'm going through implied volatility stuff. Yeah, look at that gap up. Like I said, if it gaps down or up, you're going to see the volatility go up. Like that. I have no idea what that does. That kind of thing. So I just want to show you on how I'm doing that. In fact, I see I'm going to have to go. So, and none of this, what I'm saying too expensive, I'm not paying $4 for a spread that the most I can make is $1. That's what I mean by too expensive. You want it at least you can make twice as much as what you could lose. That's what I mean. So I hope that makes sense. So that's what I'm doing in the background. Scanning for these and then looking for a defined pattern. In fact, that's not bad right there. It's a drilling stock, though it hardly ever moves. So the next thing is to look at open interest. Yeah, it's got some. I don't want to do this week. And see, the problem is you'd have to go and buy the 2.5s. That's a little rough. But yeah, there's an increase in volatility after earnings. So all I'm doing is taking the RUT active. So all I did with there is took the ones with average volume of, let's say, 300,000. That's it. And all I did was go through this and press these kind of buttons and just scan them. So that's how I do it. Everybody have a great day.